Hi everyone, my name is Vasily. I am working as an account executive with LBC Mortgage. LBC Mortgage is a company that has been on the market for more than 20 years. We are helping people in the United States and outside of the country to acquire a mortgage in order to buy a property in the United States or refinance a loan. So one of my direct responsibilities is to talk to people and explain how mortgages work, what mortgage programs are there, and if people are qualified or not. And one of the most popular problems that I'm hearing about from people like this, that they think that they're not qualified because they have heard somewhere that they would need a credit score of 700, the 20% down payment, they would need enormous income. Even if they have all of that, the rates are going to be high and there's a very high risk of default. So I have some good news for you. Most of the programs are not like that, and the government programs especially, because the government has developed a lot of programs that create a lot of flexibility for people to buy a house and without ruining their life in the future. So one of these programs is FHA. This is my favorite program. What is FHA loan? Federal Housing Administration loan. The loan that has been developed by this organization, and it allows lower credit scores, lower down payment, lower income requirements, and it has, across all of the programs that I'm aware of, it has the lowest rate. How does it work? You will need a credit score of at least 500. So if your credit score is at least 500, you can acquire a mortgage with FHA, but it will require 10% down payment. You don't have 10% down payment? Well, if your credit score is above 580, you would need to put only 3.5% down payment for the acquiring of FHA loan. The other thing is that the income requirements for these loans are also better in terms of qualification in comparison with any other loan. So you might ask, how is it possible? Lower down payment requirements, lower income requirements, lower credit score requirements, and the rates are still lower. That's a good question, and the answer to that is that you would need to pay a mortgage insurance to the lender, and the government will be backing your loan for you, and this will provide you with the rates that you're looking for. There's a lot of rumors about this loan, but there are three very important things that you would need to know besides all of that I have mentioned. First, a loan limit for government programs. How do I know what's the loan limit for you? For example, I live in Los Angeles, and I would Google 2021 Los Angeles County conforming loan limits. The other thing that you would need to know is that there is an upfront mortgage insurance premium, which is a part of the insurance that you're paying upfront to the lender. Usually it's around 1.75% of the loan amount. The good thing is that you don't have to pay it from your pocket. You can actually borrow the money for the upfront mortgage insurance from the lender, and it will not be included in the conforming loan limit. The third thing is that the mortgage insurance that you're paying on a monthly basis after this can only expire after you refinance the FHA loan into any other program, or if you actually pay off the loan. This is the only two ways. With other programs, it's better because with conforming, you can, once you repay 22%, I believe, of your mortgage, the mortgage insurance disappears. It's not the case in this situation. So as long as you hold the FHA loan with a lower rate, you would have to pay a little bit higher mortgage insurance, and you would have to pay upfront mortgage insurance in the very beginning, or you have to put it in the loan. That's it. If you have any questions, reach out and we will discuss more, because there's a lot of things that I didn't mention in this video. Follow our channel and reach out in order to buy a house. Thank you.